Alright, so let's begin the show. In the world of investments, asset allocation is key to minimizing risk and maximizing returns of your portfolio. But what exactly is asset allocation? How should investors decide their asset allocation strategies? Let's understand all this with Mr. Swaroop Mohanty, CEO Director, Mira Asset Investment Managers, and Arun Kumar, Head of Research, Funds India. Good evening and welcome to the show, Arun. First, coming to you, because one really needs to understand in layman terms what exactly this is the concept of asset allocation.
Yeah, so broadly, in very simple terms, asset allocation is essentially that if you have rupees 100 to be invested, you take a call saying how much of that 100 rupees goes into equity, how much of that 100 rupees goes into debt. So broadly, these are the two starting points. And obviously, you can add other asset classes like, say, gold or say real estate. So, and obviously cash is used as an asset class globally. But again, for all practical purposes, these four are more or less more than enough for you to build an asset allocation model. So overall, the idea is how do you split your 100 rupees into these four different asset classes? Now, especially on the mutual fund side, broadly it is equity, debt, and gold. But real estate, as we all know, obviously we have some allocation towards it. Now, whether you consider it as a part of your financial portfolio or not, it's a different question. But broadly, on all simple terms, equity, debt, and gold is a good starting point.
But Swaroop, talking about diversification, how important it is for you to be well diversified across asset classes?
I think like Arun said, you try to put your money across different asset classes. The fact remains that every asset class has its own merit, has its own behavior, and the performance of each asset class over a period of time can be very cyclical. So if you're caught in one asset class, more often than not, it goes through its ups and downs. And when you need money, and that day, if that was the downside of that asset class here, you might be caught on the wrong side. So when you allocate or you invest, there are two sides to your investing. One is the return that you want, and the second is the risk you are willing to take. Asset allocation actually merges both of them and gives you a good mix across different types of assets, like Arun rightly said, equity, debt, gold, cash. Some people look at real estate. And the proportion with which you allocate it to catch a kind of a balanced return on your overall portfolio, allocation across asset classes becomes very, very important. The key is the mix too. What you put or how much you put where will depend on your goal and the kind of risk that you're willing to take. The mix of both will give you an asset allocation grid.
Exactly. So a lot of planning and homework needs to be done from the investor's point of view also. But then, Arun, how do you determine the appropriate asset allocation for a client? Because that is a very important exercise that one needs to follow.
Yeah, so broadly, if let's keep it really simple and look at only two asset classes like equity and gold. Equity and debt. And obviously, you can extrapolate this framework to accommodate other asset classes, but just for our understanding. So the way we try to build an asset allocation portfolio is we call it the 3T framework, which is like the first T is essentially your time. So ideally, you have two different asset classes, which is equity, at least historically, has done well over the long run compared to your fixed income or debt. And again, the caveat or the catch is that in the shorter run, inevitably, you'll always have a temporary decline happening. Almost every year, if you look at Indian markets, you have a 10 to 20% kind of a decline. It's almost like a given. And once every 7-10 years, roughly, going by history, you should mentally be okay with a 30 to 60% kind of a fall. This is what has happened in the last 40 years. So more or less, at least the base expectation should be this. Now, the unfortunate part is that we do not know when that 10 to 20%, at least we know that it will happen every year, but we have no idea when is that 10 to 20% fall going to get converted into a 30 to 60%. So this is the balance of this asset class. Now, a lot of us can't handle it. So we want to curtail this temporary decline. So you add a debt, which is far more stable. But again, the trade-off here is that over long periods of time, your returns from debt is more or less, say, inflation plus 1%, while on the equity side, you can probably expect inflation plus 5 to 7%. And good fund managers are able to do a far better job over and above this. But broadly, this is the way you look at it. So the longer the time frame you have, you can accommodate more exposure to equity. So the first leg would be to look at the time frame. Anything longer than 5 years, you can accommodate equity. And the longer the time frame, you can accommodate more equity. So the second leg is the tolerance to declines. As I told you, like pure equity is 10-20% almost every year, and then 30 to 60% once every 7-10 years. So net, this is not something which a lot of us can tolerate. So you add more of debt. So let's say you put 30% of debt and make it 70% of equity. The same tolerance band probably comes to 15% of a temporary fall every year. And then the longer once in a 7-10 year kind of a major fall is reduced to the 35% vis-a-vis the 50% for pure equity. Then again, if you put 50-50, you will again reduce it to say 10% regular falls and say a 25% once in 7-10 year fall. So this is a trade-off you make. So the more you add debt, the shorter you bring that temporary fall number to. The third leg is the trade-off. Now, then obviously, if you show only the second part, then people will say, hey, I'll put almost a lot of money in debt and then reduce my temporary declines. But the caveat is that there's a trade-off on the longer run. Say somebody at 12% returns is probably doing 10x in 20 years, right? If mathematically. And if you're doing at 10%, then it's almost 7x in 20 years. And then at 8%, you are at 5x in 20 years. So the more the debt you add, your returns are also coming down, and there's a trade-off on the longer term return. So as an investor, you have to say, what's my time frame? What is the near-term declines that I am okay to tolerate? And for that declines, the more the debt I add, I also have a trade-off in terms of my long-term returns. Now, based on all these three, broadly, you can come to an asset. For most of our investors, we either go by 70 equity, 30 debt, or 50 equity, 50 debt, or 30 equity, 70 debt. Again, different investors will have a different combination based on how they look at these three T's. So that's how we come up with a broad asset allocation starting point.
All right, this is a broad asset allocation strategy, but then Swaroop, this also means that rebalancing becomes very important in this process?
Kavita, I think you've stressed upon a very important part of investing, that is the rebalance. A rebalance comes post a review of the investment portfolio. I suppose let's take an example of what Arun is saying. Suppose the portfolio is 70-30. Now, first, between you and your planner, you fix up a periodic review time, say 1 year, 2 year, 3 year, that is between you and your planner. Now, suppose it is 1 year, just for simplicity. Now, 70-30 should be your equity debt portfolio, and the markets have run up and your equity has become higher, say by 10%, or depends on whatever the market is. Suppose now it's skewed to becoming 80 and 20. It is very important to review the portfolio and see that your actual allocation is brought back to 70-30. This can be done in two ways: by taking 10% out from your equity and putting it to debt, or adding further money in debt to balance it back to 70-30. Why this is very important is that it maintains your actual asset allocation, which is closest to your risk profile. Invariably, when you start investing, you think it is a process of generating returns. Over a period of time, you realize that it is a process of mitigating risk. And the portfolio which is closest to your risk profile gives you the best investment experience. And that is what would have happened when you come to the conclusion of 70-30 to begin with. So when the markets would have fallen, suppose it's gone to 60 and your debt has become 40, it is then important to replenish 10% and bring it back to 70. Now, over a period of time, when you do it periodically and follow your review with a very unemotional rebalance, you will see that your goal achievement will be superior because you are sticking to your plan. And unless you don't rebalance post a review, most of the time the process becomes meaningless. When you look at, I'll give you a very interesting example. Say our hybrid fund is 70, typically the industry's hybrid fund is 70-30, and most of them rebalance every year. The power of increase in returns, because it rebalances every year unemotionally, is pretty substantial. So please never underestimate the power of rebalancing. And if you fixed up a time for review and rebalance, make it mandatory to meet your planner and do the review and rebalance almost unemotionally.
Exactly. But then let's also talk about subcategories within asset classes. So Arun, what type of subcategories are we talking about typically in a very well diversified portfolio? If we have to look at what all would it involve?
Yeah, so when you start with equities, broadly the usual approach would be to look at some exposure to large cap, mid cap, and then small cap. Now how do you decide on this? Broadly, you look at the overall market structure, and then say how is the say you put the top 500 stocks, and then say what is the weightage for each of these large cap, which is the top 100 stocks, and the next 150 stocks is the mid cap, and the remaining stocks are the small cap. So broadly, it would, at least from an Indian context, you will roughly have 70 to 80% in large caps, and then probably 10 to 15% in mid caps, and small caps being 5 to 10. So this is the rough metric that somebody can look at for building a very simple portfolio. The way we kind of do it is slightly different, because what we have seen is within large caps, you have different funds following different investment approaches. So thereby, when you club everything as large caps, we find that within the same category, you have very different approaches being clubbed together. So what we do is we follow something called a 5-finger strategy, which is in a simple way. Essentially, we are saying, hey, can we figure out 5 different investment approaches which have proven to work not just in India but across the world and over a long period of time. This is also fancily called factor investing, where essentially the investment styles we have identified as some fund manager who's more towards the value or the contrarian kind of an orientation. So this is one approach. The second would be like growth but at reasonable prices kind of an approach. The third would be quality, but obviously which is coming at a slightly higher expensive valuation kind of an approach. And the fourth would be your mid and small cap, which is basically saying that the smaller or the smaller sized companies will have a slightly have a slight edge over the long run. Then the last thing would be your global basket. So overall, when you combine value, growth at reasonable price, quality, mid and small cap, and global at 20% each, what we have seen is that inevitably over a cycle. So we've been running this for almost the last 3-4 years. So we've seen that each and every year there is 2 or 3 styles which do well, and then the other 2 styles don't do well. But it's very difficult to figure out which is the exact style which does well, which is the whole idea of asset allocation, that you don't have a precise idea on which asset will do well at what point in time. The same logic we apply here, saying even within the asset class, we do not know exactly which style will do well at what point in time. But if we club together all these styles which have proven to work well over 7 to 10 year cycles, then that intermittent phase where 2 or 3 funds are not doing well because of the style going through the underperformance, we are able to handle it better, because at a portfolio level, the client still has a smoother experience. So overall, this is how we do it. And within that, we pretty much we look at flexi cap funds, where flexi cap or funds where the fund manager is not constrained saying, hey, I have to have compulsorily so much into large cap, so much into mid. Except for the mid and small cap bucket, all the other 4 buckets, we predominantly go for funds where there is not much of a constraint on the fund manager. And if a contrarian fund manager finds an opportunity in whichever segment, he or she is free to do it. So that's how we do it on the equity side. On the debt side, it's fairly simple. We look at, there are only 2 risks to look at: interest rate risk and your credit risk. So we go for super high credit quality funds where at least 80% or more is into AAA oriented papers. And then on the interest rate side, we say duration of not more than 3 years. This becomes our base bucket. If you need some extra kicker on that, say up to 20 to 30% of your fixed income portion, you can put it into some categories like equity savings, where you have some equity component. We don't do credit risk funds, but there's also, you can go slightly longer duration funds to get that extra kicker. But this is completely optional for most beginner investors. I think you keep it really simple to a short term or a low duration, or this banking and PSU or corporate bond. Most of these categories have super high credit quality, and the interest rate risk is limited to less than 3-year duration. So that should be a good enough complement. So this is how we club the diversification part within equity and within debt.
All right, now within this asset allocation strategy, Swaroop, can you please explain us the difference between active and passive strategies?
It depends on how you approach investing. I think Arun will be better at answering this than me. In the fact that, it's up to the investor. Now, when you look at it at a fund management level, what is perceived to be active and passive style of investing is very different from the investor looking at it from an active or passive style of investing. I mean, when you look at a review and rebalance, according to me, that would be an active way of looking at investing, and that is the right way of looking at it. But my humble request would be to put periodic times to it, and those times should be reasonable enough for the asset class to play out. Now, if you are going to minutely track your equity portfolio on a monthly basis, it's not going to work out. So every asset allocation has a horizon. Like we typically say, equity is 3 years or debt is at least a year or so. Now, review post this to give better returns. Now, some people buy and hold. There is nothing wrong with that. But it gives you that big disadvantage of not rebalancing at times. So depends on the approach. I would be more favorable to the people who review and rebalance at a specific periodic level. That gives a better sustainable process to investing and more scientific approach to approaching the volatility or catching the upside and the downside of the market through a very clinical mathematical approach.
So, Arun, how do you look at it? Because obviously, how can one place their strategies in active or passive way? And also, how can you monitor and adjust your asset allocation over time? Do you need to adjust a client's asset allocation regularly in response to the changing market conditions?
Yeah, so the easiest question is how do we monitor asset allocations over a period? So we have 6-month reviews, whereas Swaroop said the broad idea is that how far are you deviating from the original asset allocation that you've decided. Now, some bit of deviation is fine, because automatically, I mean, if you keep your band too tight, so let's say you are at 70% equity, 30% debt, we are okay for a plus or minus 5% kind of a deviation. So let's say your portfolio is at 73% equity, we won't necessarily move 3% back, because net it's those small deviations are fine. But we have so let's say it goes to more than 5%. So let's say it comes to 76 or say 64, then we might want to rebalance. But broadly, in terms of frequency, there's been a lot of study done globally, and we've also done a lot of work around it. There has not been much of a difference, say, even if you do it 3 months or 6 months or 1 year. Most of the studies across the world have seen that there's hardly any significant differentiation, and there's no pattern to it. So broadly, we follow, while we do a 6-month review, ideally we want to do those rebalancing activities once a year, unless and until there is a very sharp move within the year. So usually, say, if you are doing it in Jan, there might be years like 2020 where you had a sharp fall of 40%. In those cases, we will want to step in and do some bit of rebalancing. But otherwise, say 90% of the times, it runs on a 1-year schedule. And in a lot of years, you might even see that it's still within the band. So it's not like every year you will be forced to do it. So this keeps your activity at a lower level, so that you are leaving the portfolio untouched for some point in time. And in only rare cases where it is required, you come and rebalance. So it's only in few years where the moves are very dramatic, and usually it's always on the equity side. So that is where you will need to step in between the year and then do some rebalancing activities. So that's how we look at the asset allocation rebalancing part. In terms of active versus passive, see, right now we're still heavy on active. So the way we look at passive is that now, because we say passive, we forget what is the underlying that goes behind it. Passive, essentially, you are saying that, hey, a larger sized company will do better than a smaller size company. So what you essentially do is you arrange all the stocks as per size, and you pick the top 100 or pick the top 200. USJ S&P 500 is the top 500 stocks. So net you are saying, hey, this is a rule which says larger the size, the better it is for my returns, and hence so in any environment where your large sized companies have done well, which has been the case for the last 10 years, especially in the US and also in India, you've seen that in the last 5 years. So usually passive tends to do well. But for us, it's yet another style. This approach of larger the better is one more style. So the way we look at it is, hey, larger the better is one style. Smaller the better is one more style, where you say mid and small caps. Higher quality the better is one more style, which you call quality. And lower valuation the better is what you call valuation style. Again, growth, the higher the growth, the better is one more style, which is growth style. So we are not biased towards one particular rule. But this being said, we think at least in the large cap segment, we think passive makes a lot more sense, because a lot of funds have a very high overlap with the index. And given the fact that the expense ratios are also on the higher side, just to compensate for that differential, you will need a significant outperformance on the remaining portion. When we checked, most of the average was only 40% of the portfolios of large cap funds were different from the index. That's also because you have a constrained narrow universe, and there are a lot of stocks which a lot of fund managers don't take. So it's a narrow index, and the overlap is inevitable. So I think it's very hard for a large cap fund manager to outperform on a consistent basis. So in that segment, we are a little more biased towards passive. But on the other end, most of the other segment, we think at least the flexi cap and all these different styles which I was speaking about, we played through active. So it's a combination of both based on the client's preference. So passive is purely large cap. But if a client wants an active portion, we club together these 5 styles and let it run. So we have both the styles available.
All right, last question. Swaroop, what are some common mistakes that investors make when it comes to their asset allocation strategies?
Yeah, typically in investing, I don't think mistakes is the right term. It's the approach. I think more often than not, the focus on the outcome is far larger than the process. The ignorance of the risk profile is something which I have also come across. People invariably choose products over the process, and that's where the process gets fundamentally flawed. It's a very simple process. First, identify why you want to invest. That is, fix your goal. That is how you give investing a tangible process. And because of this goal, everything starts working backwards. If you don't know why you want to invest, it's impossible to know where you will invest. But typically, the focus goes more on where to invest. Which is your best product? Is a question which I'm often asked. Do you need that product? Is that product suitable to you? Do you already have products which are similar to that in your portfolio? That question invariably is meaningless. What you should ask yourself is, why do you want to invest? And hence, this is my return expectation. Based on that return expectation, this is the kind of risk I can take, and hence I can invest in a certain type of asset classes. Now you continue doing that to your journey. 9 out of 10, the journey is discussed first before the process. While if the reverse is done, the investment experience can become actually pretty predictable.
All right, that will be all. Thank you so much, Swaroop and Arun, for this elaborate discussion on asset allocation and the importance of asset allocation strategies. On that note, we'll take a quick break, and post that we'll be joined by Feroz Aziz, who will be discussing and talking on hybrid mutual funds today. Welcome back. You're watching The Money Show with me, Kavita Thaplial, and let's talk about hybrid funds. Hybrid funds are mutual fund schemes which invest in more than one asset class, that is equity, debt and other asset classes, depending on the investment objective of the scheme. Now, if you are someone who's considering investing in hybrid funds, then this segment is for you. We have on board Feroz Aziz, Deputy CEO and Andrati Private Wealth, to talk more on this. Feroz, good evening and welcome to the show. So, given the backdrop of recently proposed amendments to the finance bill, from April 2023 onwards, capital gains arising from debt-oriented mutual fund schemes will be treated as short-term capital gains, irrespective of the period of holding. Now, investment in hybrid funds has emerged as a suitable option. But before we get into that, Feroz, let's discuss the category and its suitability for investors. Could you please elaborate on the types of hybrid funds we are talking about here?
Yes, hi Kavita. Like you rightly said, it's very contemporary to look at hybrid funds today, especially after the amendment to the finance bill, which got passed as well. Because hybrid funds mix both equity and debt. And if you look at the hybrid funds, there more importantly, there is conservative, aggressive, dynamic asset allocation, arbitrage, and multi-asset allocation funds. There are 5 types of hybrids if you have to classify them. The aggressive ones, of course, as the name suggests, have a larger portion in equity. The conservative ones have a larger portion in debt. Dynamic, as the name suggests, are quite fluid in terms of their allocation, and they don't stay static between their equity and debt, and so on and so forth. So arbitrage funds are very debt-like in terms of behavior. But in taxation, they are equity-like. So I'll stop here, Kavita. You can give me some pointed questions and I can answer them for you.
We have so many categories within hybrid funds. Equity savings is a neglected category. Now, you can elaborate more on that, because this category among hybrid schemes has the lowest AUM of almost 16,445 crores. But that could change soon. Do you think that for retail investors, are we looking at BAFs or equity savings which can come handy for them?
Yes, Kavita, you're absolutely right. In terms of the assets, equity savings as a category is very small. But after the change of Section 50AA, which is the new section which was introduced on the budget day, but got amended before the bill got passed, and debt funds were roped in other than MLDs, actually tells you that if there is more than 35%, anything little more than 35% in equity, then the taxation of long-term capital gains will be applicable, and you will also get indexation. So investors will look for schemes which have just about 1/3 of the money in equity, and equity savings category generally has 30 to 40% invested in equity. So I think this will start getting traction, momentum, and there's going to be a lot of investor interest because most investors actually have equity of 35% and debt of 65%. Which investor does not have 35% in equity? Most retail investors and even HNIs at least have 35%. So a combination of both these, which is what will give tax efficiency to the debt side, will definitely find some degree of tailwind. And I think this category will definitely see a push.
I would like to take you back in time, maybe to early 2000, where fixed deposits were compared with income funds, or, there were always a versus debate going on between these two categories. Do you think that's a time now?
See, I think you're right. Of course, the tax efficiency of debt funds, pure debt funds, especially the target maturity funds, which I personally think have been the reason why this change of taxation got triggered, because as per Section 48 of income tax, bonds and debentures should not get indexation. But a target maturity fund, which is nothing but 1 or 2 bonds put inside a box, they were getting indexation, which was a little loophole kind of scenario, which is why target maturity funds going forward become lesser attractive. So coming back to your question, Kavita, will there be a debate? The answer is yes, because FD's tax efficiency has suddenly become not so much of a problem, because target maturity funds will also come as short-term capital gain. But hand on heart, I think still debt funds and target maturity funds will win hands down, because capital gain as a head of income is one of the most attractive heads of income, because FDs give you interest income, and debt funds, even if they give you short-term capital gain is a very attractive head, and several set-offs are possible as per Section 73.
Feroz, I would also like to explore arbitrage fund within this category. Now, talking about pure debt allocation, do you think a move on the arbitrage fund will be seen over here? How do they work?
Yes, Kavita. I think arbitrage fund, because they buy equity and they also hedge the equity which they buy by shorting in the futures market. So from a return profile, it is more debt-like. From a taxation profile, because the underlying is equity, you're buying equity in the cash market, you're selling the same commodity in the futures market. So risks are cancelled. The difference in the price between the two markets, which is what is the arbitrage opportunity, is what arbitrage funds capitalize on. For example, if Nifty today is at 17,400, May Nifty will be at 17,500. So buying Nifty of today and selling the Nifty of 25th May, which is the last Thursday of May, the 100 rupee differential is called the arbitrage opportunity. So to answer your pointed question, Kavita, arbitrage funds are going to be very much in favor because they give equity taxation, not just debt taxation of the old regime, but even more favorable. And the short-term capital gains tax is only 15%, and long-term capital gains after 1 year is just 10%. So I think arbitrage fund is going to have a large flight of capital from the other debt categories, which from 1st of April have become lesser efficient from the taxation standpoint.
Feroz, do you agree with this, that earlier so much of thrust was not given to a hybrid category, among the debt investor category? Why was this neglected or sort of, not thrust upon?
See, Kavita, mathematically, if you forget taxation, it's always good for an investor to do asset allocation at the portfolio level, not at product level. See, what happens is if a person has, let's assume 10 lakh rupees, he is going to decide how much will go into equity, how much will go into debt on his overall 10 lakhs, and then allocate debt separately, equity separately. This has one advantage, that you are in the driver's seat when it comes to asset allocation. That's one advantage of doing that. Second, that your debt is going to be cost efficient, because if you're investing in debt, you should not spend so much money on fund managers, because in debt you can't do too much. In equity, you can spend good quality money to get the best fund management. So two advantages of doing asset allocation at your level is why hybrid funds were not in favor. Now that there is a tax advantage to make hybrid funds more attractive than pure debt funds, I think people have to relook at the advantages and measure the pros and cons and make their calls. If somebody's got just 2,000 rupees to invest in a month, then I think a hybrid fund was always a great option. But if somebody's collected a reasonable lump sum amount, I think keeping equity and debt separately always is a better strategy than mixing them up.
How can debt funds be stressed by AMCs? Now, AMCs have gone in overdrive on debt funds. You think the stress will be on outperformance over fixed deposit and product features now?
Yes, Kavita. See, basically every financial institution is fighting for the same pie, which is the household saving, which as per one of the CRISIL report is 3 crores in India. So of course, debt funds are going to have more pressure to deliver better performance than fixed deposits on a post-tax basis. But I think debt funds will also bring in some degree of tax efficiency. Even the conventional debt funds will have some degree of arbitrage, to my mind, or some degree of equity. I think the asset management company will also push equity savings schemes like you in the earlier part highlighted, Kavita. I think there will be a lot of innovative caps put. And I think as we speak, AMCs are thinking of how to bring back debt funds into post-tax efficiency so that they can compete with the FDs and have their market share as well.
Currently, looking at the longer tenure bond, do you think these are favorable for investors to invest in right now?
See, longer term bonds, Kavita, yes, I think so. We are in the interest rate cycle, which to my mind has peaked out long back. I've been saying this for the last 7-8 months. The 10-year GSEC has not moved up at all. So repo might have moved up from May 24th last year by 2.5%. But 10-year GSEC is exactly where it was on 24th May last year. So I think we are at the peak of the rate cycle. So if you're going to lock in yourself a 7.3, 7.4, even on a Government of India bond for the next 10 years, it is very lucrative. If you go to state development loans, you're getting 7.6, 7.7. But I think corporate bonds of long terms are not worth today because the remuneration these corporate bonds are giving is very little. If I'm going to get 8 with a AAA rated corporate and 7.4 with Government of India, I will always choose 7.4 because in 10 years, corporates can go through whatever they have to go through. Why will I take that risk for just a 0.6% more? So to answer your pointed question, Kavita, government bonds, state development loans, lock in for long periods of time, great idea. Corporate spreads are so thin that it's not attractive or even worth your time for that 0.5% more.
All right, Feroz, I think that's all in discussion on hybrid funds. We'll take a quick break and post that. Let's get connected with our viewers who have their portfolio strategies questions to ask. You're watching The Money Show. There are plethora of funds available in the market to invest your hard-earned money, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through all of this, we are joined by Feroz Aziz, who's there to give all your portfolio-related answers, but then you can send us your queries on our WhatsApp number, which is 8657974571. You can also email us your queries on themoneyshow@etnow.tv. So, Feroz, we have Mr. Krishna from Hyderabad on phone line with us. Good evening, sir. How are you doing? Mr. Krishna?
Yes.
Hi, I can hear you. I think we have your question. You have invested 1 lakh in Kotak Flexi Cap?
Yes.
All right. And what's the time duration for this particular investment?
Yeah, maybe it's 4 to 5 years.
5 years?
Yes.
Okay. And is this SIP or it's a lump sum investment?
Yes, I see.
SIP every month 1 lakh?
Yeah, I have. No. I have been investing per month, 5,000 rupees per month.
Okay. Okay. So you want to know if you want to stick to this particular
Yeah, should I
fund?
continue or shift to another better fund?
Do you have any other funds in your portfolio?
Sorry?
Do you have any other funds apart from this?
Yeah, yes, sir.
Which one?
Parag Parikh Flexi Cap.
Sorry?
Parag Parikh Flexi Cap.
You have Parag Parikh Flexi Cap and you have Kotak Flexi Cap.
Yes.
That's all?
Yes, that's it.
Okay. Feroz.
Yes, thanks, Kavita. You read my mind and I wanted to ask him which other schemes he has in the portfolio. Mr. Krishna, see, if you have two funds of 10,000 rupees per month, it's not wise to have both of them flexi cap. There's no rationale of having both flexi cap. There are about 8-9 categories which to our mind are attractive: large cap, mid cap, large and mid cap, small cap, multi cap. So there are several categories ideally you should take exposure to. Having 10,000 rupees and just taking exposure to one category is not the smart thing to do. Like Kavita also mentioned, there are plethora of funds. Let me define what is plethora of funds. There are 380 active funds and about 180, 190 passive funds. That's a real plethora of products. So having one category doesn't make sense. So have more categories. Let me read out some schemes for you. If you have 10,000 rupees, spread it out thin. SBI large and mid cap, Kotak emerging equities, DSP small cap, Aditya Birla small cap, HDFC Focus 30, SBI Contra. So these are separate categories. There are only 2 funds from small cap category because small cap is a marginal higher risk. So you're better off having 2 different schemes rather than one scheme, because like Aditya Birla will have a different style, DSP will have a different style. The intersection between these 2 portfolios is going to be minuscule. So these are the 6 schemes. I think you can continue with your flexi caps, but not more than 1,000 each. But I think HDFC Flexi Cap has been managed well by Harsh Upadhyay, who's also the CIO of Kotak. But I personally think it's very large in size. My analysis mathematically establishes that smaller the scheme, higher the agility, and in turn, higher the probability of generating the extra return over the passing mark of benchmark. So these are the 6 schemes you can add to your portfolio. Don't just put 2 schemes of 5,000 each.
All right. We move on to our next viewer, Shardul Lad from Thane. Shardul, hi.
Hello. Hi, ma'am.
How are you doing?
Yeah, I'm doing good. I watch your show regularly and it is very beneficial.
Thank you so much, Shardul. So you have invested in Axis Focus 25?
Yes, I have invested in Axis Focus 25 from last 1.5 years.
Okay.
And I have significant amount actually in that fund. But my portfolio is under raid. My returns are negative. So, and my horizon is 7 to 8 years. I'm not a short-term investor,
Okay.
but still I'm having a doubt. I mean, my fund selection is good or what to do, because I have a significant amount in that.
And what about your other schemes in the portfolio?
Other schemes are quite well. I mean, they are going to with the with index, because I am having some flexi cap in my portfolio, Parag flexi cap. Then index fund is there, Nifty 50, and small cap is also there, Nippon small cap. So I have chosen this focus category fund, and I chose this Axis Focus 25. But this fund is, it is not related to, it is not going with the market trend. My NAV is less down. Sorry.
All right. Feroz.
Yes, Shardul, I think you've identified the scheme right. We exited the only Axis fund in our model portfolio way back a year and a half back. And I think it was a wise decision. Now, if you look at Axis Focus, the other model portfolio scheme which we have in focus category is ICICI Focus. The difference in performance for the last 1 year between your scheme and our recommended in the model portfolio, the same category, focus category, is 20%. You are at -10 for the last 1 year, but other focus schemes are at about 8, 10, and the one which we've recommended on this show also have been 10% positive. So I would say that you have to bite the bullet and exit Axis Focus 25. Any AMC which has a lot of redemption pressures, which Axis have had, unfortunately, I'm sure they will revive from it because they're a process-driven organization. But currently, I think they are in a little vicious cycle of underperformance resulting in more outflows, and more outflows resulting in underperformance, because you will have to sell a lot of stocks to furnish redemptions. So I would say you can move to ICICI focused equity fund, which is Shankaran Naren, who's the CIO, personally oversees this fund, and I would say that it will be a good replacement.
All the best, Shardul. We move on, and we have Sunil Kumar Jha's question, and he's been investing in Axis Blue Chip, ICICI Blue Chip, Axis Mid Cap, Kotak Emerging, Axis Small Cap, Nippon Small Cap, Parag Flexi Cap, UTI Flexi Cap, Mirasit Large Cap, Canara Bank Large Cap, and 5,000 each in all these funds. And his retirement is his goal, but then the investment time horizon is 10 years.
Yes, so I think there are some changes, Mr. Jha, for your portfolio. I think you will have to get out of some schemes. I'll read out those. You have 3 Axis schemes. So 2 Axis schemes go. Axis Blue Chip, Axis Mid Cap would be an exit. Parag Flexi Cap, UTI Flexi Cap would be an exit. Canara Bank Blue Chip Equity Funds would be an exit. And Mira Asset Large Cap. So 6 schemes would be exited in our suggestion, of course, for your consideration. 4 of them could stay in the portfolio. The schemes which can be added are SBI Large and Mid Cap, HDFC Flexi Cap, ICICI Focused Equity, SBI Contra, and Kotak Multi Cap. These could come into the portfolio. That will result in a 9-scheme portfolio. Of course, these are not recommended just from the past performance standpoint, but from the portfolio constituents and our belief that those stocks as a basket should generate you alpha.
All right, we move on to our next viewer question, which is from Deepak Joshi, and he wants to invest for his daughter. She's 27 years old, and the investment time horizon is 15 to 20 years.
Yes, Kavita. So Kavita, of course, if he has, she's 27-year-old and the time duration is 15-20, I would suggest Mr. Deepak to write down schemes. There are a laundry list of them. There are about 9 of them. SBI Large and Mid Cap, HDFC Small Cap, Invesco India Small Cap, HDFC Flexi Cap, Kotak Emerging Equities, ICICI Focused Equity, SBI Contra, Kotak Multi Cap, and SBI Franklin India Blue Chip Fund. These 9 schemes, which are from different categories. Small Cap, I have given 2 different funds. One, Invesco India Small Cap, is managed by Tahir Badshah. It's a small fund with 1,400-1,500 crores. Well managed, and microscopic view of the CIO is always critical in a small cap. HDFC Small Cap, which is managed by Chirag Setalwad, he doesn't stop amazing all of them. In terms of the size of the fund, he's been able to generate excess return for years and consistently. So these are the 9 schemes which, Deepak, you can use for your daughter's investment.
We have a viewer online, Mr. V. Venkat Subramanian from New Delhi. Hello, sir. How are you doing? Good evening.
Yes, sir, yes, sir. बहुत बढ़िया.
बहुत बढ़िया.
Doing fine.
जी.
Doing fine.
Ji. Okay, so I can see you have given us your portfolio, which says you have around 6 funds in your portfolio, and
Yeah.
you're just 23. You started with this?
Yes, ma'am.
Okay, since how long you've been investing? 8 months. Okay.
8 months.
That's nice. And you got these funds identified. I mean, this is your research, or you went to a certified financial planner?
No. I have my own solution. I have done it.
Interesting. Okay. What financial goals have you lined up for yourself?
Just retirement is nothing else.
Wealth creation?
Nothing. Wealth creation and retirement.
Okay. All right. And how much corpus for that?
5 crores at the minimum level.
5 crores. Okay. Feroz, it's very nice for someone to, align a retirement goal as their first goal when they start investing or start the process at least. What do you have to say about the funds? A lot of repetition?
Yes, Kavita, a lot of repetition. Firstly, I think you've identified right. At the age of 23, if somebody is hell-bent on planning retirement, he's surely going to be financially independent and very prudent. So very good, Mr. Subramanian. Point one. Point two, I think 4 schemes ideally can go out. Canara Robeco, you have 2 schemes. Both, according to us, are not the best of Canara's flagship schemes. Canara Robeco Flexi Cap is a better scheme in their basket. Nifty 50 and Sensex, both are ETFs. I think if you mix active funds properly and choose them wisely, you will be able to beat Nifty and Sensex over long periods of time. It's a large country with great business opportunity. So sticking to Nifty and Sensex may not result in the extra 1-2%, which on a year-on-year basis you can get. So the good part is, since you are just 23 and if your retirement is at the age of 60, if you invested 30,000 rupees every month for the next 37 years, you can get to a mind-boggling number of 44-45 crores at a 14% growth in the next 37 years. So that's the kind of corpus you can accumulate, given the fact that you've decided to invest early. And that's why every investor should invest early. So I will read out some schemes which you can replace the four schemes which I mentioned: HDFC Flexi Cap, HDFC Small Cap, SBI Large and Mid Cap, Invesco India Small Cap, ICICI Focused Equity, SBI Contra, and Kotak Multicap. These schemes can definitely add to your portfolio, and please don't hesitate having 9 schemes in your portfolio, because you're going to be investing for really long periods of time, and your corpus also is reasonable. I think 30,000 rupees per month can get you places.
All right, we move on to our last question. Halim from Chennai, and he says that he's been investing in Motilal Oswal Flexi Cap since last 4 years, and he's not seeing any positive movement in this fund. He wants to understand if he still should hold this fund in the portfolio, and it's for long term, 8 to 10 years.
I think Motilal Oswal, correct me if I'm wrong, Motilal Oswal Multi-Cap Fund, is that the scheme which you mentioned, Kavita ji?
Flexi Cap. He says Flexi Cap.
Yes. Motilal Oswal Flexi Cap, I think what has happened is, when you look at Motilal Oswal as a fund house, their principle has not worked for the last 1-2 years. But I personally think their philosophy of buying right and sitting tight and having a low churn ratio on the funds is not such a bad strategy. You've got about 4% return over the last 1 year, which isn't too bad, but isn't too good as well. If you look at the model portfolio 11 schemes, I think most of them have outperformed a flexi cap, but never have one scheme in your portfolio. If this is the only scheme, Mr. Halim, you have to be very worried. Mutual fund, because of the ease of investing and the lower capital need, 500 rupees or 1,000 rupees, helps you buy 6-7 funds. Even if one fund manager falters, you have other people to make up for one bad or one dud fund. So SBI Large and Mid Cap, HDFC Small Cap, Invesco Small Cap, Kotak Emerging Equity, HDFC Flexi Cap, ICICI Focused Equity, SBI Contra, and Kotak Emerging, Kotak Multicap. All different funds from different categories, different asset management companies, different fund managers as well. So that will give you a very diversified portfolio. Even if one or two, which is bound to happen, that if you have 8-9 schemes, you're going to have 2 of them which will not deliver. So there are going to be the other 7 who will save the light at the end of the tunnel. So they will let you see the light at the end of the tunnel. So Alim, so have a more diversified mutual fund portfolio.
Right. On that note, thank you so much, Feroz, for removing time and helping our viewers with their financial portfolio. But we move on. Well, we all know the IPL season has begun. Cricket, as we all know, is where factors like fitness, speed and agility are important. And talking of fitness, Herbalife has a proven record of helping athletes optimize their performance. The premier global nutrition company has now become the official partner of Tata Indian Premier League for the season 2023. Here's a report.